Cisco crushed the quarter, but inventories exploded 80% to $5.69 billion, and gross margins slipped. And that tells you exactly where the risk is hiding. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Cisco Systems gets graded and traded. Alright, on the top line, revenue came in about 2.5% ahead of estimates. That's not a huge headline number, but for a company Cisco's size, that's still a real beat, and it comes on top of already strong growth heading into this print. On the earnings side, they came in about 8% above what analysts expected. EPS is what Wall Street grades a company on, so a clean beat like this, on a name this big, gets Wall Street's attention right away. So the beat itself earns a B. A revenue beat plus an 8% EPS beat is solid, but it's not the kind of blowout that pushes into A territory on the surprise size alone. And on consistency, this earns an A. Cisco has been reliably beating quarter after quarter, and that kind of track record is exactly what the consistency grade is measuring. Let's talk about the positives from the report. Revenue came in at $17.3 billion, up 18% from a year ago, and that topped the high end of their own forecast. When a company this big is growing revenue by 18%, that's a real acceleration. Businesses this size just don't move that fast unless something big is going right. Here's the one I keep coming back to. They booked $4 billion in AI orders from the big cloud companies in just this one quarter, and $9.3 billion for the full year. These are the giant tech companies that build the data centers powering AI, and they're buying Cisco's networking gear to connect it all. This is the number that proves Cisco is a real player in the AI build-out, not just a legacy networking name. And management raised the bar for next year. They guided full-year revenue to about $72 to $73 billion, and earnings per share to about $5. Both of those are meaningfully above what they just delivered. When management raises guidance like this, it means they can see the demand in their order book. They wouldn't put those numbers out there if they weren't confident. Their operating margin, which is basically how much profit they keep from every dollar of sales before certain costs, hit 35.9%. Management called this the highest productivity they've had in 30 years. That means they're squeezing more profit out of the business than they have in a generation. And they gave shareholders $3.2 billion in just this quarter, split between dividends and buying back their own stock. Buybacks shrink the share count, which makes each remaining share worth more. So this is real money going straight back to shareholders on top of the growth story. So on profitability, this earns an A-. Record operating margins in 30 years, plus operating income up 38% is genuinely strong. The only reason it's not a straight A is that gross margins slipped a little, which we'll get to. Now let's talk about the negatives from the report. Inventories jumped 80% to $5.69 billion from $3.16 billion a year ago. Inventories are all the products they've built but haven't sold yet. A jump this big is either a good sign, meaning they're stocking up because they see huge orders coming, or a bad sign, meaning stuff is piling up because it isn't selling as fast as they expected. On this print, it's probably the first one, but it's a number to watch closely next quarter. Gross margin, which is the profit they keep on each product before other expenses, slipped from 68.4% to 66.3%. That drop is happening because the big cloud companies buying all that AI gear negotiate harder on price than regular business customers. So the more Cisco sells to those hyperscalers, the more this margin gets squeezed. The reported earnings number looks amazing, up 52% from last year, but that number is inflated. About $869 million of it came from gains on investments they own, not from actually selling products. Strip that out, and the clean earnings growth is closer to 23%, which is still great. just not the 52% monster the headline suggested. Their short-term debt jumped to $10.2 billion from $5.2 billion a year ago. That's basically doubled. Now, Cisco is a huge company with plenty of cash flow to handle it, but debt this size doubling in a year is something to keep an eye on going forward. And the services business was flat compared to last year, which means all of Cisco's growth is coming from selling products. Services revenue is the more predictable, recurring kind of money, so having growth concentrated entirely in products makes the business a little more sensitive to the ups and downs of the AI order cycle. On guidance, this earns an A. Management raised full-year revenue and earnings guidance meaningfully above what they just delivered, and they gave detailed quarterly numbers too. That's the strongest possible signal from a management team. And on red flags, I'm at a C+. The AI story is real, but the inventory build, the margin compression, and the doubling of short-term debt all point to a business that's changing shape underneath the strong headline numbers. Not deal breakers, but real things to watch. Putting it all together, this was a decisive double beat and raise, and it validates the idea that Cisco is a real winner in the AI build-out, not just a legacy networking company. The AI order book, the raised guidance, and the record operating margins all point in the same direction. The one thing to keep watching is gross margin, because as more of the business comes from the giant cloud customers, that margin can keep drifting lower. But overall, Cisco is meaningfully better positioned than it was 3 months ago, and I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. Chasing shares, right after an 18% revenue beat and a raised fiscal 2027 outlook almost never works out for me, so I'm sitting on my hands here. I'd rather let the initial gap settle and give myself a 2 to 3 week window to see where the first real pullback shows up before I commit any money. In the meantime, I'd sell cash-secured puts about 5 to 10% below the post-print price to grab the fat premium, and if I get a sign near that level, the fiscal 2027 revenue guidance of $72.2 to $73.4 billion and the $7.5 billion AI revenue expectation make me happy to hold through it. So for me, that's the play here. Wait for the pullback and sell puts into it. With the raised full-year guidance and a $9.3 billion AI order backlog, I'm comfortable moving my strikes closer to the money than I would have before this print. For me, 30 delta puts out 30 to 45 days is the sweet spot given how much visibility management just handed us. My strike floor sits around $111.53 because that's roughly where Cisco was buying back its own shares last quarter, and my ceiling is a level I'd actually be happy owning at and start writing covered calls against, not just a number that pays a big premium. So I'm moving my strikes closer in and respecting that buyback floor. I'm holding my shares here because the fiscal 2027 outlook, calling for revenue of $72.2 to $73.4 billion and non-GAAP EPS of $5.05 to $5.11, really extends the earnings runway on this name. On top of that, I've got $8.1 billion of buyback authorization still available and a 42-cent quarterly dividend, and that combination gives me a real floor under the stock. The one thing I'm watching is that 210 percentage point year-over-year drop in non-GAAP gross margin down to 66.3%. And if margins stabilize next quarter, I'm adding on any 8 to 10% pullback instead of trimming. So I'm holding, watching margins, and looking to add on dips. The raised guidance tells me I do not want my shares called away at the strikes I picked before this print. So if my covered calls are now in the money after the pop, I'm rolling them up and out to capture more of this AI narrative rather than closing them at a loss. For any new covered calls I write, I'm going further out of the money than felt right before earnings, targeting around 20 to 25 delta. The $7.5 billion fiscal 2027 AI revenue target and 35% order growth tell me there's probably more upside coming over the next quarter or two, and I don't want to cap it too tightly. So I'm rolling my calls up and out and writing new ones further out of the money. I'm holding my leaps here because the fiscal 2027 revenue outlook implies 14 to 16% growth accelerating on top of the 12% Cisco just delivered. And that's exactly the kind of setup I bought these calls for. The $9.3 billion AI order book gives me visibility that easily supports carrying these leaps through calendar 2027. If my leaps are deep in the money after this print, I'm rolling the strikes up to pull some capital off the table while extending my expirations out into 2027, because the thesis is stronger now, not finished. So I'm holding, rolling strikes up, and stretching my duration out. Honestly, if I were underwater on Cisco after a print like this, I'd have to admit something went wrong with my cost basis, because the thesis just got stronger on every dimension I care about. This release validated revenue, order growth, guidance, and capital return all at once. So I'm not questioning the story. I'm questioning my entry. For adding to what I already own, the $9.3 billion AI backlog, the raised fiscal 2027 outlook, and the 27% year-over-year jump in fourth quarter operating cash flow to $5.4 billion all tell me to average in on any 7 to 10% pullback, rather than chase the strength here. So I'm adding on 7 to 10% pullbacks, not into strength. Bottom line, this print earns a B+ from me. The AI story finally showed up in the numbers, management raised the bar for next year, and the operating margins are the best they've been in 30 years. Just keep an eye on that inventory build and the gross margin trend, because that's where the story could get complicated next quarter. Thanks for watching, and I'll see you on the next one.